Now let's now take our next topic in chapter 1, and we said that we are concluding this discussion next week. Before the end of next week, we have two more lessons to conclude chapter 1, whereby chapter 1 is about accounting for assets and liabilities. Remember, this is advanced financial reporting and analysis. Chapter 1 is about accounting for assets and liabilities, whereby you are supposed to cover leases, within leasing, finance lease, operating lease, deferred taxes with group aspects. We have done that. Now we are moving to employee benefits. This is IAS 19. Now I want us to be a little bit faster as far as employee benefits is concerned, because employee benefits is not it's not a difficult area to tackle for a student. Now, employee benefits, as you can see from this side, I just want to give you. I want us to do this topic with an illustration to make it more easier. We can take two examples, and then as we take the examples, I'll also be giving you some theory. The example that we have used here is, or for the purpose of illustration, we have used May 2019, question 3A, Advanced Financial Reporting. May 2019, question 3A, Advanced Financial Reporting. You can see it here, Employee Benefits, IAS 19, May 2019, question 3A. And then after we do the analysis of employee benefits, I'll give you an exercise that is September 2015, question 4A. I told you to download these past papers to make your work easier, so that whenever you are doing an illustration, you should be able to have your paper with you, so that you can follow our solutions easily. Now, I will start by giving you a format of how we prepare some of these accounts that you find in employee benefits. And as you can see from this side, you will be having a table like this one with defined plan asset, and the other table will be for defined plan liability. That's very important for now. You must have one table for defined plan asset as well as defined plan liability. Now, once you have known that, you should know the items that you find in the first table. For defined plan asset, you will have the first item will be fair value of plan assets brought forward. That is a starting balance by the start of the year. The examiner will always give you that opening balance. So this one will be given by the start of the year. For example, if you're preparing these accounts for the year 2025, the examiner will give you the present value or the fair value of plan asset from 2024, that 1st December 2024. And that is the balance that you open 2025 with. So this one here, fair value of plan asset brought forward. And then the other balance that will be given is the closing balance. If you are preparing these accounts for the year 2025, then the balance is that 1st December 2025. So in other words, you'll be given the opening balance. If assuming that these are accounts for the year 2025, you should have the balance for, that is as at 1st January 2025, which which is coming from 2024, and also the balance carried down is at that 1st December 2025, assuming that your records are for the year 2025. So you have this information will be provided, fair value of plan asset by the end and fair value of plan asset by the start. Now, once you have known that, understand with a defined plan asset, you'll be adding the contribution to the plan. You'll be given how much contributions was made to the plan by the employer or the employees or both. Contributions to the plan increases the asset, the opening balance. Return on plan asset. Now, return on plan asset will increase that asset. Now, in all these questions, you'll be given a certain rate of return, maybe 3%, 8%, or 10%. So that rate of return, you just be multiplying that rate of return by opening balance. That's important point. Anytime you are given rate of return in the additional information, just take that rate of return, then you multiply by opening balance to get rate of return, rate on plan asset. That figure should be entered. Then benefits paid, you'll be given the benefits paid, so that should be deducted. So deduct benefits paid. Now, when you work out these 4 items here, that is fair value of plan asset brought forward, the opening balance, which is coming from previous year. We earn contributions to the plan. We also plus return on plan asset. I've told you this return on plan asset. You'll be given a certain rate of return. You multiply by the opening balance, and you have this figure here. Then you less benefits paid. Once you work out that, you get carrying amount. Or the adjustments here for these 4 figures gives you the carrying amount. Having in mind that you have calculated your carrying amount, you have been provided with fair value of plan assets by the end. So what you do is that you compare this carrying amount here, which you have calculated, with the fair value of plan assets by the end. So if it is an increase, remember this is a defined plan asset. When the defined plan asset increases, then we say that that is actuarial gain. Note here, this is your balancing figure here. So this will not be given. The actuarial gain or loss. This actuarial gain or loss, this balancing figure can either be a plus or a minus. And we have said that we know how to calculate these figures. Up to here, the carrying amount. Once you have this carrying amount here, you are given fair value of plan asset by the end. Check whether it is an increase or decrease. If it is an increase, remember this is the balancing figure. You are comparing the carrying amount which you have calculated with the fair value of plan asset by the end. You are dealing with the plan asset. If it is an increase, then that is an actuarial gain. If it is a minus, that is if assets are reduced, then that means that is actuarial loss. Okay, I'll come back to this example, but I just want to show you the items which will appear in the defined plan asset. That is it. Now, once you get that, you now prepare the other table, which is to do with defined plan liability. Defined plan liability. So realize that the present value of obligation, the other name for obligation is liability. So present value of obligation brought forward, the starting balance. This figure is coming from previous year. So this will be given. Another figure which will be given is a closing balance for that particular year. Opening balance most of the times will be provided. Closing balance will also be provided. Then look at the items which are supposed to appear in the defined plan liability account. One, what we earn here, note that with the defined plan liability, the items which are appearing here are all expenses. or expenses. For the assets, we do not have expenses here. Contribution to the plan is not an expense. Return on a plan asset, the interest which is multiplied by the opening figure is really not an expense. So these are sort of incomes as far as the defined plan asset is concerned. So realize here what is happening here. What is increasing the present value of obligation, the opening balance? This is a liability. It is these expenses here. One, current service cost. You'll be given the current service cost, past service cost that will be provided, interest cost. Now, interest cost, what you do, you'll be given a certain interest rate, maybe 3% or 5%. That percentage you multiply by the opening balance to get interest cost, which will appear there as a plus, then you less benefits paid. Notice, benefit paid is deducted in both cases. The same figure. You'll be given one benefits paid figure. So you less it here on the defined plan asset account. You also less it here on the defined plan liability. The same figure. Like for example, in this example that you're going to take, you can see 242 is the same 242 which was deducted there. So it's the same figure. So what you earned here in the present value of obligation, remember the opening balance, we earned current service cost, we also earned past service cost, we also earned interest cost, which is that rate times opening balance, the figure is there. Then benefits paid you less, the same as what was deducted there. Then, after adjusting these figures here, you get carrying amount. That is present value of obligation brought forward. We earned current service cost. We also earned past service cost. We earned interest cost. We less benefits paid. We get the carrying amount. Now this carrying amount, you are always provided with, most of the times, if not always, you are provided with present value of obligation here. So compare the carrying amount which we have calculated from up here, compare with the present value of obligation by the end. Note that this is a liability. If this figure increases, when a liability increases, then that is actually a loss. Again, note that this is a balancing figure. The balancing figure gives you the actual gain or loss. So you check your carrying amount, compare with the closing balance here, which is provided. If it increases, that means a liability has increased. So what does it mean? That is an actual loss. If a liability reduces, then that is a gain. That is actual gain. The opposite for assets. That is, if you get your carrying amount and you are given the fair value by the end, if that asset reduces, then that is actually a loss. An asset reduces, if the carrying amount reduces now from that figure to the closing figure, then that is a loss. But if the asset increases, then that is actual gain. It's the opposite for the liability. So that is what we expect as far as this particular chapter is concerned. So we have said that it's quite simple as far as this particular topic is concerned. So to save time, we have decided that we discuss the theory part of it as well as the calculations together. Then after that, I'll give you this exercise, September 2015, question 4a. Now let's look at this question, which appears on the board. Now I'll project it to you. I think you have the past papers with you. I believe you have the past papers. And that is May 2019, question 3a, Advanced Financial Reporting. Now I read it as it appears here, then I project it to you. This topic does not have much work to do or to be done at all. W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligations as at 1st January 2018 was shillings 38 million, and the fair value of the plan assets as at the same date was shillings 2860. So what you need to do is that understand this format, the way it is presented here, because yours will only be picking that number and then fixing it where it belongs. So like for example here, so in the examination, understand my defined or your defined plan asset as these items here, the way they appear here. You give us space for actuarial gain or loss because it will be the balancing figure comparing the carrying amount with the fair value of the plan asset. So understand these items, how they appear for the defined plan asset, and also for defined plan liability, how these items appear. Just write them the way they appear there before you even insert those numbers there. Now, for example, in this question, we are told that W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligations is at 1st January was 38. That 8, you can see this figure here is given, that 8. That is what you are told. That is the present value of the future benefit obligation is at 1st January. You are told 1st January. It is an obligation by 1st January 2018, meaning it was a closing balance as at that 1st December 2027. So our closing balance from 2027 is on opening balance obligation, and that is what you are given there. So you just insert that number there because I believe you have understood all what appears here. Now the next, let's continue. You are told is that and the fair value of the plan asset as at the same date was 2860. You are told on the same date. So you have been given the opening balances. That is fair value of plan asset as at the start, 2860, and the present value of the obligation or the liability is at the start. So all those ones have been given. So we continue. So I'll project this one, the question to you in a while, but I believe you have the past papers with you. So I think you are following what I'm doing here. But if you do not have the past paper with you, I'll project again the past paper for you then to see what you have done here. So that is the figures as presented. Then the next you are told further information relating to the pension plan for the year ended that 1st December 2018 was as follows. Now let me show you what I'm saying. I'll show you what I'm saying. I try to see what I've just discussed. Can you see there? Not H, but W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligation, those are obligations, as at 1st January 2018 was 38. So you can see where I have taken the 38 and the fair value of the plan assets as at the same date was 2860 million. So those are my opening balances, one going to the obligation, the other going to the asset. Now let's move to the other further information relating to the pension plan for the year ended that 1st December 2018 was as follows. So you can see that Current service cost is given. Benefits paid to the former employees. Contributions paid into the plan. Fair value of benefit. Fair value of benefits obligations is that 1st December 2018, and fair value of plan assets is that 1st December 2018. So those last two items there, they are the closing balances. So just note that information there, because you're just fixing them where they belong. So you can pause your video and then you record that somewhere. So let's do that from the board. I show you. You can see where we have fixed those items, I believe. So we have been given opening balances. Opening balances have been given, isn't it? These opening balances have been given. Now closing balances. Now you are told, before you go to that, find the information relating to the pension plan for the year ended that 1st December 2018 was as follows. Current service cost 209. We have said costs or expenses will increase the liability, the plan of liability or the plan obligation. So current service cost has been given 209. It will appear there. You just put it there. Next, benefits paid to former employees 242. We say that benefits paid will appear on both the defined plan asset as well as the defined plan liability. So your benefits paid here 242. 242, it will also be here. 242. It will appear in both cases. 242 is benefits paid. It's always deducted. I think that has been noted. Then the other item, contributions paid into the plan. That is not an expense. Expenses are the ones which come to the defined plan liability. So here it is benefits, or not benefits, but contributions paid into the plan. 259 should appear there. Contributions to the plan, contributions, 259. The other is present value of benefit obligations as at 1st December 2018. That's the closing balance for the obligation. 3360. That figure there, 3360. 3360 is given there. Then fair value of plan assets is at that 1st December 2018. That 113. That 113 is there. The closing balances. I've told you most of these items will be given. Yours is only to know the format. So yours is only to fix that figure where it's supposed to be appropriately. Now you are told in the additional information, interest costs into brackets, gross yield on blue chip corporate bonds is at 5%. Now I've told you that to calculate return on plan asset, there is a certain rate that will be given. So to get return on plan asset, you take that rate, you multiply by opening balance. You do the same with the defined plan liability. You take that particular rate, you multiply by opening balance, and then you'll have calculated the interest cost. Now what I'm saying is what you find in additional information number 1. We'll be able to see that. Additional information number 1. Read that. Interest cost gross yield on blue chip corporation bonds is at 5%. Is at 5%. That is number 1. Is at 5%. So what is the implication? That one helps us to contribute to calculate two things, that is return on plan asset, 5%, 5% of opening balance, 2860. You multiply by 2860, you get 143. That is a return on plan assets. The same applies here. Interest costs for the defined plan liability, 5% times opening balance. 5% times opening balance, we get 154. 154. Additional information number 2, we are told on 1st January 2018, the pension plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits as at 1st January 2018 was calculated by actuaries at shillings 110 million. Now that is what we refer to as past service cost. So note number 2 is telling you something known as past service cost. I'll project that one for you. You read for yourself. Maybe you do not have the past paper, because I don't know whether you have the past paper or not. It is my responsibility to project it so that you don't complain. So is that number 2, is it legible? On 1st January 2018, the pension plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits is at 1st January 2018 was calculated by actuarial. That's at shillings what? 110 million. 110 million. So simply, that means past service cost. So costs or expenses will come on the defined plan liability, and that is the past service cost 110. What else is missing? Do we have everything? I think so. If you look at the defined plan asset, you have said fair value of plan asset brought forward was 2860. That was given from the start, where the question starts. Because you have been told W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligation as at 1st January 2018 was shillings 38, this obligation, that 8, and the fair value of the plan assets as at the same date was shillings 2860. So this one is given and that one is given. The opening balances are given. Now all the other items are given. Contribution to the plan 259, return on plan asset, that particular percentage or rate given in additional information number 1, where you are told interest costs, into brackets, gross yield on blue chip corporate bonds is at 5%. So the return on plan asset, the 5% times opening balance, benefits paid is deducted on both sides, from the defined plan liability and also from the defined plan asset. So you less that. Now once you less that, what you get is a carrying amount. So in our case here, we are getting 3020. So 3020, you compare with the closing balance, which has been given. Fair value of plan asset carried down has been given there in the question. It is given present value, that is fair value of plan assets as at that 1st December 2018 was 3113. So because you have calculated your carrying amount and then this figure has been provided, you compare, you ask yourself, this is an asset. It is increasing from 3020 to 3111. It is an increase. that 20. From that 20, you just look at my carrying amount. My carrying amount, remember, the actual gain or loss is a balancing figure. You do not have this figure. That one is not there. You are the one to fix it there by comparing your carrying amount with the fair value of the plan asset. It can be a decrease or increase. If it is an asset, if it is increasing, then that is actual gain for the asset. If it is reducing, then that is for the asset, then it is actual loss. The opposite for the liability. If liability increases, then that is actual loss. If liability decreases, then that is actual gain. Back to our defined plan asset. Our carrying amount we got at that 20. Remember, after you earned this plus this plus this minus that, you got that 20 as your carrying amount. Then you compare with the fair value of the plan asset by the end, which is provided. So what is happening here? From that 20 to that 113. Obviously, that is an increase by 93. So that is actual gain. So that will be an actual gain. We have actual gain of 93. So you are through that. That is just as simple as that. Nothing much. Nothing much there. So that is that. You come to the second one. Defined plan liability. Present value of obligation. The opening balance was given. Current service cost was given at 209. Past service cost was given as 110. Additional information number 2. Interest cost, you take 5% times opening balance. That's 20. We got 154. Then we less benefits paid. 242. The same figure here. So I've told you that benefits paid is deducted in both cases. So the same figure you are deducting from the defined plan asset as the benefits paid is the same figure that you deduct from that side, 242, the same. So once you do that, what you get is a carrying amount. Now in my case here, this plus this plus this plus that minus that, I got 3311 as my carrying amount. Now note that we are only comparing, or we should compare the carrying amount with the closing balance by the end of the year. And this figure is given. Most of the times, the closing balances and the opening balances are provided. So, your carrying amount is 3311, and so remember this one is the balancing figure. The actual gain or loss. You are the one to fix it there. After comparing your carrying amount with the present value of the obligation by the end of the year. So compare that 311 with that 360. Obviously, this looks like increase 3311 to 3360. It has increased by 49 by 49. So when a liability increases, then that is a loss. So that is the 49 is actual loss. This is actual loss. Actual loss. But if a liability decreases, then that will be actual gain. So in our case here, 49 becomes an actual loss. So that's the balancing figure there. And by so doing, you have presented your records or your statements for this particular employee benefit plan. So how then to conclude on the same, the net gain, because realize that your assets increased. Your assets increased by 93, but your liabilities decreased by 49. So what does it mean? You have an actual gain from the assets, but actual loss from the liabilities. So there is an increase of 93, but that increase of 93 was offset. Not really offsetting, but was reduced by this particular loss coming from the defined plan liability. So what is the net gain? You just get this 93 that is an actual gain from the defined plan asset, that particular increase, you less this particular loss, 49, and you get 44. So the net gain is 44. So how do you account for that? The 44, it is a gain. Gain, that you go to other comprehensive income as well as then equity reserve. So that is how you account for that. So net gain, you just look at the two balancing figures there, the actual gain or loss. The balancing figure from the defined plan asset and the balancing figure from the defined plan liability, you combine them together like what we have done there. The difference is the net gain, can even be a net loss, not a loss. It need not always to be necessarily a gain, it can be a negative. But in our case, because there was a gain of 93, there was actual gain of 93, and actual loss of 49, 93 minus 49, you are left with 44, and that figure goes to other comprehensive incomes as well as to the equity reserve. So that is the end of that. That is how you could have attempted that particular question. Very simple. Now, something else that I want to mention here is that the examiner may give you this kind of a question, but covering several years. For example, 2024, 2025, 2026. Now, what you do is that you just present the same format. Nothing changes there. Only that you'll be having, for example, here 2021, then another column here for 2022, another column for 2023. Now, the closing balance here becomes your opening balance. For example, if this is 2021, you have your 2022 here. Remember, the calculations for defined plan asset should be taken separately from the calculations for defined plan liability. So if the question is covering several years, the same concept remains. So these items, as they appear here, they don't change for the defined plan asset. These items, as they appear in the defined plan liability, they don't change. So you just need to master these items, how they appear here, for the defined plan liability as well as for the defined plan asset. So the only thing here is situations where the examiner requires you to present information for several years. So it is for 3 years, for example, 2021, you have this. Assuming that there was another year, 2022 here, what you could have done, because all this the examiner will give you for each year. For example, here you have a fair value of plan asset by the start, but the examiner won't only give you this one for the first year. This one which has been given here will be the opening balance here when you come here. And then contributions will be given, returns, you just take that particular percentage times opening balance. The process continues. The closing balance here will be the opening balance the next year. And the same will apply here. If you have several years, for example, I assume this is 2021 and you have 2022 there, for example. So what you do is, the 3360 here will be here. 3360 becomes your opening balance. The examiner will give you the current service cost for 2022. They will give you the past service cost, the interest cost. You just take that particular percentage given times the opening balance. Then you continue the process. You have your closing balance here, it becomes the opening balance, and then the process continues. So when you get a question whereby, which is covering several years, everything else will be provided. Only that it will be upon you to take the closing balance in the first year to be the opening balance next year. Having in mind that the defined plan asset should be prepared separately from the defined plan liability, because out of these actual gains and losses arising in this particular account should be aggregated with the actual gains and losses arising from the other account to establish whether there was a net gain or loss, as we have done. So that's a simple question, very easy. and I think you have understood what you have done. Well, I think I should now give you the question from September 2015. September 2015 question. September 2015 question 4a. Now you are told, I read it for you. I can illustrate it before I leave it to you. Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value of the pension plan asset was shillings 2.6 million, and the present value plan liabilities was shillings 2.9 million. So as I've told you, most of these figures will be provided. So here you are told that fair value of the plan asset by the start of the year is 2.6. So for the plan asset, the 2.6 will be here, 2.6. Then the plan liabilities, the present value of the plan liabilities by the start, 2.9, it will appear there. Then you are told the actuary estimated current and past service costs. The same. You are given what? Current service cost and the past service cost. They have told you that you are given the actually estimated current and past service costs for the year ended that 1st December 2014 at shillings 450,000 and 90,000 respectively. So these ones have been given. You just put them there. You just fix them there. And then the past service cost is caused by an improvement in pension benefits commencing that 1st December 2014. The pension plan paid shillings 240,000 on that 1st December 2014. The pension plan paid shillings 240,000. So that is what? Benefits paid. We are told they paid 240,000. So benefits paid 240 will be there. It appears in both sides. I've told you that benefits paid will be deducted from the defined plan liability as well as from the defined plan asset. So they paid 240,000. That is what you are told. The pension plan paid shillings 240,000 on that 1st December 2014, and on the same date, Volta Limited paid shillings 730,000 in contribution to the plan. So contribution to the plan 730. You are told 730 to appear there. Interest rate on high quality corporate bonds for the year was 8%. So that is for calculating one. Return on plan asset, you are told 8%. So return on plan asset, you take 8%, which is given there, times opening balance. Then the same will apply here. Interest cost, 8% times opening balance, the one you are given here. Then you are told, as at the year end, I've told you, you'll be given the opening balances, some of these items there, and then the closing balances. So finally, they will give you the present value of obligation for the liability as well as for the plan asset. And I think that is what they are trying to tell you. As at the year end, fair value of pension plan asset was 3.4. So fair value of plan asset 3.4 will be there. And present value plan liabilities was 3.5. 3.5 will be there. So next thing, what do? You just try to add up whatever you'll be having there. You get carrying amount, compare with closing, check whether it is increase or decrease, and that will be your balancing figure, either actuarial gain or loss. If an asset increases, that is from carrying amount to fair value. If it is an increase, then that is actuarial gain. If it is reducing, that is actuarial loss. Do the same for undefined plan liability. You get the carrying amount here, compare with present value obligation, closing balance. If a liability increases, then that is an actuarial loss. If a liability reduces, that will be actuarial gain. Okay. In accordance with year 2011 revision to IAS 19 employee benefits. Volta Limited recognizes measurement gains and losses in other comprehensive income in the period they occur. So I've told you that this net gain or losses, whatever you get, the differences that you get from actuarial gain or loss compared with what you got from the defined plan liability, that difference will go to other comprehensive incomes as well as to equity reserve. And that is what they are telling you in accordance with year 2011. Now, why are we using 2011? You may be asking, what do you mean by that? Is that the year? No, in accordance with year 2011. Now, what we mean by that statement is that because employee benefits IAS 19 was introduced in the year 1983. 1983. So from 1983, it was amended in the year 2011. So the amendments for IAS 19 was done in the year 2011. So that 2011 there is not affecting the kind of the calculations that you are doing for this particular question, the 2011. So they are only trying to tell you, or in other words, what they are mentioning there is the amendments which were made concerning IAS 19 in the year 2011. So I've told you that IAS 19, that is employee benefits, was introduced in the year 1983 and it was subjected to certain amendments in the year 2011. That is where they are telling you, in accordance with year 2011 revision to IAS 19 employee benefits, Volta Limited recognizes measurement gains and losses in other comprehensive income in the period they occur. Required, calculate the measurement gains or losses on pension plan assets and liabilities that will be included in other comprehensive incomes for the year ended that 1st December 2014. And you are given 6 months. Now that is very easy for you. You can just check how we have done that particular question. You can check that. May 2019, question 3. Then I project your assignment. I've given you some clue. This is May 2019, question 3A. We have done that. I've given you an assignment, exercise, September 2015, question 4A. If you do not have that paper, you should not be worried. I'll present it to you. If you don't have the paper, I'll show you the paper. If you don't have the paper, this is your assignment. Take your assignment and you make sure you do the assignment. Make sure you do the assignment. That is how it appears there. Your assignment is there, question 4. 4A. Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value of the pension plan assets was shillings 2.6 million and the present value plan liabilities were shillings 2.9. So do you know where to take that information? Those are opening balances. So I've shown you where to take those figures. Like, do I need to repeat that? I don't think so. I've told you what to do. I've told you what to do those figures. Since you are told that Volta Limited operates a defined retirement benefit plan for its employees on 1st January, so those are opening balances. On 1st January 2014, the fair value of the pension plan asset was 2.6. So 2.6 will be here. 2.6 will be there. Fair value of the plan assets. will be there, 2.6 will be there, 2.6. And the present value, plan liabilities, was 2.9. So your 2.9 will be there. I think I'll explain that to you. Okay, let me continue presenting. Let me continue showing you your question if you don't have the past paper. All right, it is there. The actuary estimated current and past service costs for the year ended that 1st December 2024 at shillings 450,000 and shillings what? 90,000 respectively. The past service cost is caused by an improvement in pension benefits commencing that 1st December 2014. So simply, you have current and past service costs. Current and past service costs. The actuary estimated current and past service costs for the year ended that 1st December 2014 at shilling 450,000 and 9,000 respectively. So current and past, you just fix them there, current and past. So they'll be part of the defined plan liability. You just fix them there. Then the next information, you are told, let me present the last part. I leave you with the rest now. I think I've shown you what to do. That is your information. The pension plan paid shillings 240,000 on that 1st December 2014, and on the same date, Voter Limited paid shillings 7,000 in contribution to the plan. Okay, so you have that. Where do you take 240 and where do you take 7? That interest rate on high quality corporate bond for the year was 8%. As at the year end, fair value of pension plan assets was 3.4, and present value plan liabilities was what? 3.5. Okay, I think now everything is there with you. Everything is there with you. So I think everything is okay with that particular assignment or that particular question. Everything is okay with you. Unless you have a question. Unless you have a question. You can just check the solution that we have for May 2019, question 3A. If you are not able to do that exercise, I'll give you my number. I think you still have my number. If you do not have my number, I'll give you my number. We'll do some theories next lesson. We have said that, and I think we started that theory yesterday. We did some theories yesterday, whereby we said that IAS 19 prescribes that employee benefit costs should be recognized as a liability or an expense. A liability should be recognized when an employee has provided the service in exchange of benefits to be received by the employee at some time in the future. An expense should be recognized when an entity enjoys economic benefits from a service provided by an employee, regardless of when the employee received or will receive the benefits for providing the service. The basic problem is that an entity will often enjoy economic benefits from the services provided by its employee in advance, but the employees will not receive all the benefits until they retire. Then we say there are four types of benefits. One, short-term benefits. Short-term benefits are benefits falling due within 12 months after providing the services. So if you are employed, you work for, and then you are paid by the end of the month, then those are short-term benefits, or just paid within the course of the year. Those are short-term benefits. Then long-term benefits, benefits falling due in a period exceeding 12 months. E.g., example is a study leave. So you have short-term benefits which are paid within the course of the year. Then long-term benefits paid after 1 year. Then termination benefits. These are benefits payable as a result of the company's decision to terminate the employee's contract before the normal retirement period, or an employee's decision to accept an early voluntary retirement in exchange for the benefit. That is termination benefit. You can decide to retire. And then once you retire or you lose your job, then you are paid some benefits. That's termination benefits. Then post-employment benefits, also known as retirement benefits. These are benefits that accrue to an employee after the normal retirement date. So I think that is something that we discussed yesterday. And then the other part was to do with types of pension plans. We discussed defined contribution plan and defined benefit plan. What's the difference between the two? We defined what is a defined contribution plan. In this plan, I think that is what we said. We said undefined in a defined contribution plan. In this plan, the employer agrees to contribute a certain specified sum of money each year to the funding agent, i.e., the employer's contributions are defined, but the benefits that the employees will receive are not defined. The amount to be paid as benefits will depend on the performance of the investment in the fund. Okay, you see, once you pay this money, if, for example, it is NSSF, National Social Security Fund, they use that money to invest, and then they will pay you when you retire out of the returns coming from those investments. That's a defined contribution plan. Then we have the other type known as defined benefit plan. In this plan, the benefits that the employees will receive are determined in advance, i.e., benefits are fixed or defined, but contributions are not defined. Right, I think those are terms that we defined last time. We also defined what is current service cost, what is a past service cost, what are vested employee benefits, what is plan asset. So we discussed all that yesterday, and I think we do not have any challenge as far as that discussion is concerned. So nothing else is required out of that. Make sure you finish that assignment. You finish that assignment before tomorrow, because tomorrow you take one more question. But the question that you take tomorrow is the same as this, but it will be for several years. I've told you what the difference will be. You just be carrying forward the closing balance to be the opening balance. For example, if I was having 2022 there, I'll just bring this one as my opening balance there. All the others will be given for each year. Nothing to be calculated. Closing balance becomes your opening balance. If it is return on the plan asset, you'll be given a certain percentage, you just multiply by opening balance. For defined plan liability, the closing balance becomes opening balance, and then the process continues. So I'll take one more question next lesson with several several years. So what is the basis of this employee benefit plan? Now, what it means, what it is talking about is situations where an employee is deducted some amount by, let me say, by the government, so that you may understand well. For example, in Kenya, we have NSSF, National Social Security Fund. Each month, employees are deducted a certain amount by NSSF. The employer pays some amount, the employee pays some amount. This amount goes to NSSF. So what NSSF will do is that they will invest that money, and then, because for example, if they invest in real estate, then these uh, these buildings or these houses will be generating income. Then you have been working for maybe 20 years. After you retire, because they have been using your money to invest, then after you retire at 55 or at 60, then they will pay you that interest which they have received from those investments. That's basically what is found in employee benefits. So we'll have one more question with our solution, as we also discuss a little bit of theories from the same. So that is enough for today, because I believe this is not a difficult area to deal with. So I'll take one more question, not now, but employee benefits, I think we have only one more lesson, 1 hour. Uh, then we'll move to share-based payments. Share-based payments. So you can start reading in advance. The share-based payment is where we are moving to. The share-based payment. After you've done the share-based payment, you remain with one major thing in chapter 1, that is impairment of assets. Okay, numbers are here. 2 plus 254. 7, 2, 7, 8, 7, 10, 9, 3. 0, 7, 2, 7, 8, 7, 10, 9, 3. Remember 2. You know what to do? Doing this or doing that. You are liking the video. You are subscribing. You are making a comment. I told you to be part of us, so that as you continue waiting for the examination, we move together with the advanced financial reporting and all the other subjects. So that even if you are studying from other colleges, you also compare what you are doing there and what you are doing here. We are in a free market whereby you can have there are a lot of sources of information nowadays, so you can compare what you are doing here with what you are doing wherever, so that by the end of the day, the consumer becomes the biggest beneficiary, where there is competition and there is a lot of information. So you have no reason to complain about your examination being difficult. So be part of us, subscribe, we will notify you whenever we upload a video. So this is Fatima Institute Center for CIFA Studies. So let's meet tomorrow as we take one more question, and then we move to share-based payment. So take the assignment, and if you face any challenge, just communicate through this number there. Okay, let's meet tomorrow. Okay.